Your parents are fine. You are fine. And then one day, a simple fall turns into months of help, bills, and stress you did not see coming. Here's the scary part. Most families do not get hit by long-term care costs because someone dies. They get hit because someone lives and needs help every day. So in this video, I am going to walk you through the biggest long-term care insurance mistakes beginners make and how to avoid them step by step. And stick around because near the end, I will share the one question that quietly reveals whether you even need long-term care insurance at all, or if you can safely skip it without gambling your future. Number 1, believing it will not happen to you. The biggest mistake is not a policy mistake. It is a mindset mistake. A lot of people think long-term care is only for very old people or only for people with serious diseases. But the most common long-term care story starts with something simple: a stroke, a bad fall, a car accident, or memory issues that build slowly. One estimate says about 70% of Americans who reach age 65 will need some form of long-term care at some point. Example: imagine your dad is 68 and still driving, working, and mowing the lawn. Then he slips on wet steps. He's not sick, but now he cannot safely shower alone. Suddenly, your family is hiring help, taking time off work, and arguing about schedules. That is long-term care. Step by step, avoid this mistake by doing one simple exercise. List the daily tasks you would need help with if you could not use your legs well for 6 months. Bathing, dressing, toileting, eating, getting in and out of bed. If that list makes you uneasy, you are thinking clearly. Number 2, thinking health insurance or Medicare will pay for it.
This is the one sentence people hear too late. Most traditional health insurance covers medical treatment. Long-term care is different. It is help with daily living. Many beginners assume Medicare will cover years of help at home or in a facility. In reality, it is limited and rule-heavy. That confusion is why families get blindsided. Example: your mom needs help bathing and eating every day because of dementia. That is not a hospital problem. That is a daily life problem, and daily life care can become a private pay problem fast. Step by step, avoid this mistake by separating 2 buckets in your head. Bucket 1 is medical care: doctor visits, surgery, rehab after an injury. Bucket 2 is custodial care: ongoing help with daily activities. Long-term care planning is about bucket 2. Number 3, waiting too long and getting denied. People think long-term care insurance is something you buy when you start needing help, but that is like trying to buy car insurance after the crash. Long-term care insurance is usually medically underwritten. If you wait until you have certain conditions, you may pay a lot more, get fewer options, or get declined. Example: a couple decides at age 62 they will look into it later. At age 67, one spouse is diagnosed with mild cognitive impairment. Now the affordable options shrink or disappear. Step by step. First, pick a target window to shop, often your 50s to early 60s. Second, request a simple quote range to see what is realistic. Third, if you are not ready to buy, at least learn what health factors could block approval. That way you can act before the door closes. Number 4, underestimating the real price of care. This mistake is brutal because it turns "maybe we can handle it" into "we are drowning."
Care can be expensive even before you reach a nursing home. A recent national median snapshot shows about $34 per hour for a home health aide, about $5,900 per month for assisted living, and about $350 per day for a private nursing home room. If you do quick math, $350 per day can be roughly $127,750 per year. Example: your family hires help for 5 hours a day, 5 days a week at $34 per hour. That is about $850 a week. That is roughly $44,200 a year, and that is not even 24-hour care. Step by step, avoid this mistake. Look up your state or city costs, not just national numbers. Then estimate 3 scenarios: a few hours a day, assisted living, and nursing home. Finally, compare those numbers to your savings and income. This is how you see the real gap. Number 5. Buying a policy based on premium only. A cheap policy that does not pay when you need it is not cheap. It is a trap. Beginners often shop like this: what is the lowest monthly premium I can get? But long-term care insurance is more like building a safety net. The details decide whether the net holds. Example: 2 policies cost similar amounts. One covers home care well, the other mostly works if you move into a facility. If your goal is to stay at home, the second policy could fail you in the moment that matters most. Step by step, compare policies using this simple checklist. Does it pay for home care? Does it cover assisted living? What triggers benefits? For example, needing help with activities of daily living. How long benefits can last? How much it pays per day or month? If you cannot explain those 5 points in plain words, you are not ready to choose. Number 6. Picking the wrong daily benefit and benefit period.
This is where people accidentally buy too little or too much. Daily benefit is how much the policy pays per day or per month. Benefit period is how long it can pay. Beginners either guess or they copy a friend, and both are risky. Example: someone picks $150 per day because it sounds like a lot, but their local private room cost is around $350 per day. Now the policy covers less than half, and the family pays the rest. Step by step. Start with your local care costs. Use home care and facility costs. Decide your goal: stay at home as long as possible, or you are fine with assisted living. Then choose a daily benefit that matches that goal. After that, choose a benefit period that matches your risk. Many people aim to cover a multi-year scenario rather than an unlimited one, because unlimited coverage can get expensive. Number 7. Skipping inflation protection and getting crushed later. Inflation protection is one of the most misunderstood parts and one of the most important. Care costs can rise over time, so a daily benefit that looks fine today can look tiny 20 years from now. Example: you buy a policy at 55 that pays $200 per day. At 75, care costs are much higher, and $200 per day barely covers basic help. Step by step, ask yourself when you are most likely to use the policy. Often that is many years in the future. Then look at inflation options and how they grow benefits. Finally, balance affordability with protection. The goal is not perfection. The goal is not getting left behind by rising costs. Premiums can jump a lot with stronger inflation protection, so do not guess. Run the numbers and choose intentionally. Number 8. Choosing a long elimination period without a cash buffer.
Elimination period is like a deductible, but in days. It is the waiting period before the policy starts paying. People pick a long elimination period to lower premiums and then forget they need cash to survive that waiting period. Example: you choose a 90-day elimination period to save money. Then your spouse needs care right away. You must cover the first 90 days out of pocket. If care is $5,900 per month for assisted living, those months can hurt. Step by step. Decide how many months of care you could pay from savings without panic. If the answer is 1 month, a long elimination period is dangerous. If you have a strong emergency fund and good income, you can take more risk. Match the elimination period to your real cash ability, not your hopes. Number 9. Ignoring how claims actually work. This is a painful mistake because it shows up when you are already stressed. People assume if we need help, the policy pays. But claims are a process. You may need paperwork, care plans, and proof that triggers were met. Example, a daughter hires a neighbor to help her dad bathe and eat. The policy requires a licensed agency for reimbursement or requires specific documentation. Now the family is scrambling. Step by step. Before you buy, ask how benefits are triggered. Ask what documentation is needed. Ask if family caregivers can be paid and under what rules. Ask how reimbursement works and how long payments typically take. Do this now while your brain is calm, not later when your family is exhausted. Number 10. Not considering alternatives when traditional long-term care insurance is not a fit. Traditional long-term care insurance is not the only route.
Some people cannot qualify medically. Some do not like the idea of use it or lose it. Some want a plan that can also leave money to family. Alternatives can include a hybrid life insurance with long-term care features, or an annuity-based approach, or simply a self-funding plan with strict boundaries. Example, a couple has strong savings but hates the idea of paying premiums for decades and maybe never claiming. They explore a hybrid option where unused value can still provide a death benefit. That may feel emotionally easier for them. Step by step. First, decide what bothers you about traditional coverage: price, underwriting, fear of rate increases, or wasting money. Second, explore at least one alternative that addresses that concern. Third, compare based on outcomes, not marketing. What happens if you need care? What happens if you never need care? Number 11. Forgetting the family plan and Medicaid reality. Even if you buy insurance, long-term care is still a family issue. Someone will make decisions. Someone will coordinate care. Someone may manage bills. And if you do not buy insurance, many families end up relying on savings until it is gone, and then looking at Medicaid rules, which can be strict and vary by state. Example, two siblings never talk about a plan. A crisis hits, one sibling does everything and grows resentful. The other feels shut out. Money arguments explode. Step by step. Have one conversation now, before a crisis. Ask these 3 questions. If you needed help, would you want care at home first, or would you be open to assisted living? Who would handle paperwork and decisions if you could not? What is the funding plan? Insurance, savings, family support, or a mix?
Now, here is the curiosity question I promised. It quietly tells you if long-term care insurance is worth a serious look. Ask yourself, if I had to pay for care for 3 years, could I do it without wrecking my spouse's life or my children's lives? If the honest answer is no, you have a real reason to plan. Number 12. Ignoring future rate increases. Long-term care insurance premiums can rise later. Not always, not for every policy, but it is a real risk you need to plan for. The mistake is buying a premium that is barely affordable today, with zero backup plan if it rises. Example, you buy a policy that feels fine at 55. Then, a few years later, the premium goes up. If your budget has no breathing room, you might drop the policy right before the years when you need it most. Step by step. Before you buy, stress test your budget. Ask, if this cost rose, could I still keep it? Also ask what your options are if rates rise. Can you reduce the benefit instead of canceling completely? Build a B plan now, not in panic later. Number 13. Not checking the insurer and policy stability. This is not like buying a toaster. You are buying a promise that may need to last decades. Beginners often shop based on brand recognition or the lowest quote without thinking about long-term stability. Example, 2 companies offer similar coverage. One has a strong track record in long-term care. The other is new to the space and changes products often. If you are betting on a long promise, history matters. Step by step. Ask how long the company has been offering long-term care coverage. Ask how often they update or close policy lines. Ask what happens if they stop selling that policy in the future. You are not trying to predict the future perfectly. You are trying to avoid obvious red flags. Number 14. Skipping shared care for couples who need it. If you are married or partnered, there is a common feature called shared care. It can let one spouse use extra benefits if the other spouse does not need them. A lot of couples either do not know it exists or assume it is automatically included. Example: you and your spouse each buy a policy with 3 years of benefits. Years later, one spouse needs 5 years of care. Without shared care, the benefits can run out. With shared care, you might have a pool that stretches further. Step by step. If you are a couple, ask if shared care is available. Then ask how it works in plain language. Does it truly share a pool, or does it only extend benefits in limited situations? If one spouse has much higher risk, shared care can be a big deal. Number 15. Forgetting non-forfeiture and lapse protection. This one is boring, and that is exactly why it hurts people. Policies can lapse if premiums are not paid. Life gets messy, someone forgets, someone gets sick, a bill is missed, and years of premiums can disappear with nothing to show. Example: an older adult handles bills for the household. After a health crisis, bills get missed for a few months. The long-term care policy lapses quietly. The family discovers it only when they try to file a claim later. Step by step. Set up automatic payments if possible. Make sure at least 2 trusted people know the policy exists and know where the paperwork is. Ask about lapse protection options and what notices are sent if payments are missed. This is not paranoia. This is basic safety. Number 16. Assuming any caregiver setup will be reimbursed. Some people plan to use a friend, neighbor, or family member for caregiving and assume the policy will pay. But policies can have rules about who can provide care and what paperwork is required. Example: your aunt helps your dad a few hours a day. She is doing real work, but if the policy requires a licensed agency or specific documentation, your reimbursement might be delayed or denied. Step by step. Before you buy, ask if informal caregivers can be paid. Ask what qualifications are required. Ask what records you must keep. Then decide your plan: professional agency, family caregiver with documentation, or a mix. Number 17. Not matching the policy to your real lifestyle and home setup. Your house and lifestyle shape what care looks like. Beginners buy coverage without thinking about stairs, bathrooms, living alone, or distance from family. Example: you live in a 2-story home with the bedroom upstairs. If mobility becomes an issue, staying at home may require changes, like moving the bedroom downstairs or adding equipment. That can change the type and cost of care you need. Step by step. Do a quick home reality check. If you could not climb stairs, could you still live there? If you could not drive, how would you get groceries and appointments? Then choose coverage that supports the care style you would actually use, not the fantasy version. Number 18. Treating this like a one-time purchase instead of a living plan. Life changes, your income changes, your savings change, your family situation changes. The mistake is buying a policy and never revisiting it.
You buy a policy at 55. At 62, you move to a more expensive area. Care costs are higher. Or you build more savings and decide you want a shorter benefit period. If you never review, your plan can drift away from reality. Once a year, do a simple review. Has your budget changed? Has your health changed? Has your goal changed, like aging at home versus moving closer to family? A plan you review is a plan you can trust. Long-term care planning is not about fear. It is about keeping choices. It is the difference between picking the care you want and taking whatever is left when money runs out. So here is your simple action plan for this week. Learn your local cost of care numbers. List your assets and income that could fund care. Decide if your risk is best handled by insurance, savings, or a mix. and talk to your family about what you want before life forces the conversation. Now, I want to hear from you. What feels like the biggest long-term care insurance mistake people make? Ignoring rate increases, letting a policy lapse, or never reviewing the plan?